Welcome back to the channel. New year, new drama. This week we are breaking down holiday thin trading, rising yields, global PMI signals, and trade policy uncertainty. So let's start with the biggest story. The classic year-end Santa rally failed to ignite, and 2026 opened with a messy tug of war. U.S. stocks seesawed all session long, a sign that liquidity was thin and conviction was even thinner. By the close, the Dow was up about 0.2%, the S&P 500 was only slightly higher, and the Nasdaq barely positive. Even with that bounce, all three major indexes still finished the holiday-shortened week lower. Meanwhile, Treasury yields climbed, which kept a lid on easy risk-taking. Now, here's what matters. Leadership rotated toward value and so-called AI infrastructure areas like industrials and utilities, and that tells you the market is excited but not carefree. And when the first trading day feels this twitchy, traders start questioning how sturdy the next leg really is. Bond markets quietly tightened the screws as yields edged higher and expectations around rate cuts kept shifting. The rate debate stayed the hidden force behind every trade, keeping risk appetite firmly in check. On this chart, you can see U.S. Treasury yields, with the 2-year and the 10-year both pushing higher into year-end. The front end stayed sticky, reflecting expectations that policy rates would remain restrictive for longer than many hoped. Meanwhile, the 10-year also moved up, signaling that inflation risk and fiscal concerns were back in the conversation. That combination kept the curve under pressure and reminded investors that easing expectations were not a one-way street. In other words, rate bets were being repriced in real time, and that shift quietly tightened financial conditions again. Europe started the year with a split personality. Equity markets pushed to fresh highs, but the economic data underneath turned noticeably weaker. That contrast set the tone for a very uneasy rally. Here is the reality check behind those record headlines: Euro area inflation. This line tracks Euro area HICP inflation year over year from 2023 into early 2026, and it is the data point the ECB and markets keep circling. When this reading cools, rate cut expectations usually get louder, and that can prop up stocks even if growth feels shaky. But if it stops improving, that is when the whole soft landing story starts to wobble. So the setup is simple: watch whether the trend keeps easing or starts to stall, because that shift changes everything for European risk assets. China delivered one of the cleaner macro positives of the week. The official manufacturing PMI moved back into expansion in December, rising to 50.1. Now, here is what matters that supported global risk sentiment, but investors still watched whether demand and exports could keep the bounce alive into early 2026. Year-end positioning told a two-sided story. Investors put about $16.9 billion into U.S. equity funds in the final week of 2025, but money market funds also pulled in roughly $83.7 billion. Bond funds, meanwhile, saw about $2.1 billion in outflows. So what does this mean for us? People want upside exposure, but they are still stocking up on cash and safety. That is not euphoria, it is nervous optimism. Now zooming in on the SPY, the SPDR S&P 500 ETF that tracks the broader U.S. stock market. Prices closed back above the 50 days moving average for 10 straight sessions since mid-December, and that level has not been undercut even intraday. This tells us buyers are still defending the trend, even in a thin and jittery holiday tape. But here is the tension: the market is holding support without showing real momentum follow-through. That fits the mood perfectly. Cautious optimism with traders leaning long but gripping the exit handle. This ties back to the warning signs starting to creep in under the surface. Price pushed to a higher high, but the MACD printed a lower high, a classic bearish divergence that hints at a possible trend rollover. At the same time, the MACD histogram has been negative for 2 sessions and continues to sink, showing downside momentum quietly building. That contrast captures the mood of the week perfectly, price holding up, but internals flashing early caution. Looking closer at the Fibonacci map, price is hovering right near point B around 681.71, essentially a decision zone within a tight ATR band. The next retracement at 23.6% sits just above around 684, so even a small bounce would test whether sellers step back in. With momentum already soft, the preferred read here is short on a reflex rally toward the 38.2 to 61.8% zone, while a clean break above that would force a rethink. Shifting to the trend channel view, SPY is back inside its rising channel, but only for 1 session and right on the lower boundary. The channel is strong, with most sessions contained since mid-April, yet the room left to the downside is basically zero, while there is roughly 3% of air above. With price pressing that lower rail on rising volume, this is the moment where dips either get aggressively bought or the floor gives way. So, if this lower line holds, the path of least resistance is a snap back higher inside the channel, but a clean break would flip the mood from cautious optimism to outright defensive fast. Turning to QQQ, the Invesco Nasdaq 100 ETF that tracks the heavyweight growth in tech names, the tone immediately darkens. Price has closed below the 50 days moving average for 2 sessions, and sellers have pushed the market lower 3 days in a row. The Chaikin money flow is negative, which tells us distribution is taking place rather than fresh buying. In the bigger picture, this pullback is about 3.8%, something that has happened many times before, but the context matters with rates firm and risk appetite shaky. So, this is not panic yet, but it is a clear signal that tech leadership is wobbling and traders are stepping back fast. Digging deeper into momentum, the MACD histogram on QQQ is flashing louder warning signals. It has been negative for 2 days and is still falling, which confirms that bearish momentum is accelerating rather than stabilizing. So, even if price tries to bounce, this setup says rallies are vulnerable and sellers still have the upper hand for now. Zooming out to the Fibonacci setup on QQQ, price is sitting right near point B around 614, a classic make-or-break zone. The next retracement is only a fraction higher near 616.8, so even a modest bounce would run straight into potential selling pressure. With momentum already leaning bearish, the favored play remains selling reflex rallies into the 38 to 62% zone, while dip buyers need extremely tight risk if they try to fade this move. Stepping back to the broader trend structure on QQQ, price has been trading below the rising channel for 4 straight sessions. The former lower boundary is now acting as resistance, with the 50 days moving average nearby adding extra pressure overhead. With volume picking up as price presses into that area, this setup says rebounds are being sold and confidence is still fragile rather than rebuilding. Meanwhile, shifting over to DIA, the SPDR Dow Jones Industrial Average ETF, the picture looks very different. Volatility is tightly compressed with a TTM squeeze active for a second session, which often precedes a sharp expansion. Buyers controlled the close, with price finishing in the top quarter of the daily range, and the intraday range itself was far larger than recent averages. That combination leans bullish, but confirmation only comes with a decisive break outside the Bollinger Bands. So, while tech is wobbling, the old economy names are quietly coiling for a potentially explosive move. Following that squeeze setup, the Fibonacci levels on DIA show price parked right near point B around 480.36, another decision zone. The 23.6% retracement sits just overhead near 482.07, and a reflex rally into roughly 483 to 485 is where sellers may try to fade the move again. But here's the key point. Until DIA clears those retracement levels cleanly, extensions only matter after a confirmed break of B, so this is still a tight, high-stakes chess match. Wrapping it together in DIA, the index is still comfortably inside its rising trend channel and has held that structure for 14 straight sessions. There is slightly more room to the upside than the downside, and price is sitting well above the lower band while still below the upper boundary. That steady channel behavior reinforces the theme of the week, rotation and relative strength rather than broad market panic. Turning our focus to IWM, the iShares Russell 2000 ETF representing small caps, we finally see a different kind of signal. The RSI has just crossed back above 50, which tells us momentum is starting to tilt toward the bulls. If that level holds, pullbacks tend to stay shallow and trend. Following setups usually work better. In a market full of hesitation, this is one of the cleaner early signs that risk appetite may be trying to rebuild under the surface. What stands out next on IWM is the volatility picture tightening even further. The TTM squeeze has been active for 3 sessions, buyers controlled the close again, and that combination raises the odds of a sharp expansion. With the short-term bias leaning bullish, the only thing missing now is a decisive close outside the Bollinger Bands to reveal direction. Finally, looking at the broader trend structure on IWM, price is still trading below its rising channel for a 4th straight session. The lower band is acting as resistance, but the 50 days moving average stepped in as support, which is a subtle but important detail. With volume rising as price presses back toward the channel, this sets up a tense moment where small caps either reclaim the trend or roll over again, perfectly matching the cautious but opportunistic mood of the week. Switching gears to crypto, Bitcoin, the largest digital asset by market value, is flashing a classic pressure cooker setup. Volatility has collapsed into a tight Bollinger Band squeeze that has persisted for 5 days, a pattern that often precedes an explosive move. In a week where risk appetite feels fragile but curious, this compression tells us the market is coiling, waiting for a catalyst to force direction. Whether that release comes higher or lower will say a lot about how much speculative confidence is left as the new year begins. Drilling into the pattern, Bitcoin is also carving out a high-quality double bottom on the daily chart. Price defended the same zone twice near the mid-80,000s, and the neckline sits up near 94,600. This structure is well balanced and mature, meaning a clean break and hold above the neckline could open the door to a much larger upside move, while failure below the recent lows would invalidate the bullish case fast. Stepping back to the bigger structure, Bitcoin is still trapped inside a falling trend channel that has controlled price for 15 sessions. There is more room to the downside than the upside inside this channel, and the upper band has been respected repeatedly, keeping rallies capped. That tension says any bullish breakout needs real follow-through, because until the channel breaks, sellers still technically own the trend. Turning to rates, the 10-year Treasury yield is sending a loud message through momentum. The MACD just bounced higher from the zero line, a classic bullish rejection that signals upward pressure on yields is back in control. That matters because rising yields were one of the quiet forces capping risk appetite during the holiday week. With bonds losing their bid, equities are being forced to justify every bounce instead of floating higher for free. Looking beneath the surface, the 10-year yield is also carving out a rising wedge that has been tightening for nearly 2 months. That pattern carries a clear bearish reversal risk for yields if support breaks, with a potential move toward the high 3.9s. Until that happens, yields remain elevated, but the compression tells us a decisive rates move is getting closer and equities are bracing for the outcome. Pulling it together on the 10-year yield, price is now trading above its falling trend channel for a 2nd straight session. The former upper band has flipped into support, and the most recent pullback was bought right at that level before yields push higher again. That behavior keeps upward pressure in play for now and reinforces why rates remained a persistent headwind for risk assets into the turn of the year. Shifting over to the US dollar, the downtrend is still clearly intact. The dollar index has now closed below its 50 days moving average for 16 straight sessions, confirming sustained medium-term weakness. Even though buyers have managed 3 consecutive positive closes, this looks more like a controlled rebound inside a broader decline than a true trend reversal, which continues to influence global risk positioning. Focusing on the pattern, the dollar index has confirmed a bullish breakout from a falling wedge. That breakout came after strong compression and 3 consecutive closes above resistance, signaling a genuine reversal attempt rather than a random bounce. With upside targets clustering near the round 100 area and key moving averages nearby, this is a spot where dollar strength could quietly reassert itself and reshape cross-market flows. Stepping back to the bigger structure, the dollar index is still moving inside a well-defined falling trend channel. Price is boxed in with very little room in either direction, sitting just under the upper boundary and only slightly above the lower edge, which keeps tension high. That tight compression suggests any push toward the channel extremes could quickly force traders to react, especially if momentum suddenly expands. Shifting gears into commodities, crude oil is still stuck in a midterm downtrend, with the close sitting under the 50 days moving average for 18 straight sessions. The pullback is about 8.9%, and moves that big or bigger have happened 31 times in the last 5 years, so this is not some once-in-a-lifetime glitch. It is the kind of slide that keeps traders edgy, because rallies can fail fast when that 50 days is overhead. So, keep an eye on how price behaves around that moving average, because that's where a lot of would-be rebounds go to die. Meanwhile, crude oil volatility has completely collapsed, with ATR sitting in the lowest 1% of the last 252 trading days. That kind of calm is unsettling because it often shows up right before the market snaps out of its trance. When oil goes this quiet after a sustained slide, traders start bracing for a sudden, violent move rather than a gentle drift. Looking ahead, crude oil remains stuck inside a falling trend channel for 10 straight sessions, and that structure is still doing its job. There is roughly equal room in both directions, with about 3.5% to the upper band and 3% to the lower band, keeping price trapped in a tight decision zone. That balance reinforces the uneasy mood because in a market this quiet and compressed, even a modest push can suddenly feel dramatic. Meanwhile, gold is quietly doing the opposite of risk assets, holding firm above its 50 days moving average for an incredible 92 consecutive sessions. Even when price dipped intraday and briefly pierced that average by less than 1%, buyers stepped in and never allowed a daily close below it. That kind of resilience feeds the defensive narrative, as capital keeps gravitating toward assets that feel stable while everything else looks fragile. On top of that, gold momentum is confirming the strength, with RSI firmly holding above 40 and now pushing through 60. That kind of RSI range shift usually signals a transition into a sustained uptrend, where pullbacks tend to get bought quickly instead of falling apart. In a market this nervous, that bullish momentum profile reinforces gold's role as a preferred shelter. Stepping back, gold is now firmly trading inside a rising trend channel for 4 sessions, and the structure looks solid rather than stretched. There is still roughly 2 to 3% of room on either side, with price sitting just below the upper band, which keeps the upside open without looking euphoric. In this risk-averse backdrop, that steady upward channel reinforces why gold keeps attracting flows while other markets wobble. Turning to volatility, the VIX has been pinned below 20 for 26 straight sessions, a stretch that screams complacency. This kind of prolonged calm makes the market feel almost sleepy, with traders growing comfortable and risk premiums getting crushed. That quiet can be deceptive, because history shows these low volatility regimes often end abruptly when something finally jolts expectations. From that sleepy VIX backdrop, we swing back to SPY, and the price is basically glued to the lower rail of its rising trend channel. It is back inside the channel for just one session, sitting at the lower boundary within about 10 basis points, with almost no room left to the downside. That sets up a lopsided map, roughly 3.1% of room above versus essentially 0 below, and the lower band has been respected again today. But the vibe is tense because price is pressing that line with rising volume, and in a regime with a strong 7 out of 10 channel rating and multiple past breakouts, the next push tends to matter. Next week watchlist, the calendar finally wakes up, and the market will have to pick a direction. Monday brings US ISM Manufacturing PMI for December, with the last read at 48.2 and consensus around 48.3. Then Wednesday is a double hit ISM Services PMI with the prior at 52.6 and consensus near 52.3, plus JOLTS job openings, last at 7.670 million with consensus around 7.73 million. But the real pressure test is Friday, starting with building permits and housing starts, where the prior permits print was 1.33 million and prior starts were 1.307 million. Right after that comes the main event, non-farm payrolls for December, with the prior at 64K and consensus near 55K, alongside the unemployment rate, last at 4.6% with consensus around 4.5%. And to close the week, Michigan consumer sentiment prelim for January lands with a prior at 52.9, so this is the kind of lineup that can turn a small move into a very loud move fast. Looking ahead, the whole setup feels deceptively quiet. The charts are coiled, volatility is suppressed, and positioning looks cautious rather than confident. That calm can be comforting, but history says this is often when risk sneaks back in. The market feels balanced on a knife edge, where patience can suddenly flip into urgency.